Good day, YouTube. This is Jay Money with Falling Forward Financial. Just a article here on 4 of the safest dividend stocks to help you crush inflation. And this just came out 7 hours ago. I've been doing a couple of these videos and just kind of seeing how it goes and see what replies and views I get on these, and that might determine if I do any more of these going forward. They are kind of interesting. But again, this is for the safest dividend stocks to crush your inflation. You can comment if you have any of these, if you're yes or no for these, or if you have a better dividend stock. That would be interesting as well. So a number of factors like easy monetary policy, supply chain issues, and labor shortages drove the annualized inflation rate up 7% in December. Even though the Federal Reserve has promised interest rate hikes this year to curb inflation, the problem almost certainly won't be fixed overnight. The good news for investors is that there are plenty of quality dividend growth stocks that can help protect your purchasing power regardless of how long it takes the Federal Reserve to get inflation under control. That's something that seems like we hear about every other day. Here are 4 dividend stocks to consider with durable competitive advantages and plenty of room for growth. First is Hershey. The confectioner Hershey generates enough excess cash each quarter to offer investors a 1.8% dividend yield, which is moderately higher than the S&P's 1.4%. That strong cash generation is supporting by strong sales of top brands like Kit Kat, Twizzlers, and several variations of its famous chocolate bars. Hershey market-beating payout also appears positioned to keep growing by at least the high single digits annually for the foreseeable future. Stock's payout ratio was quite manageable at just 47.4%. Last year. This should allow Hershey to continue paying out the dividend while also executing complementary acquisitions. At the global snacks market is expected to grow 6.7% annually from $493.4 billion in 2020 to $732.6 billion by 2026. So that's quite a growth, a little bit over $200 billion. So there's plenty of growth potential for the company. Next is American Tower. I've heard of this one before. I have not purchased it yet. The Cell Tower Real Estate Investment Trust, REIT, which I have quite a few REITs. Went over some REITs here on the channel. American Tower, AMT, pays a generous 2.3% dividend yield. Supported by multiple factors, the company is the largest cell tower REIT in the world, with approximately 219,000 communication sites across 25 countries. American Tower's dividend payout ratio is 52%. That means the company has the capital necessary to meet the growing global demand for cell towers without sacrificing its dividend or dividends' future growth. Analysts anticipate that the global telecom towers market will grow at a compound annual rate of 14.5% from $39.5 billion in 2018 to $114.1 billion in 2026. And as the largest cell tower REIT, American Tower should be able to increase its adjustable funds from operations. That would be consistent with the 13.7 annual AFFO per share improvement that has posted from 2010 to 2020. At the current $246 share price, the stock has a price to AFFO of 25.5 based on the guidance for 2021. Rational price of American Tower given its prospects. Next is Union Pacific. Railroad operator Union Pacific, UNP, pays out a dividend of 1.9 yield. The payout ratio last year was 43.1, leaving room for the dividend to keep growing rapidly. Approximately 28% of U.S. freight is moved via railway, The second most common means of transport behind trucks, Union Pacific's 32,000 miles of track covering the western two-thirds of the U.S. Make the company an indispensable part of the economy. As both the domestic and global consumption increase, Union Pacific will play an important role in transporting goods. That's why analysts are predicting it will deliver 17% annual earnings growth in the next 5 years. At $241 a share, Union Pacific stock is trading a P/E ratio below 21. With its inflation crushing potential, this is a reasonable valuation for shares of the stock. Next is Broadcom, the semiconductor manufacturer Broadcom, ticker AVGO. Pays out a dividend each quarter with a 2.8% yield, higher than the previous three stocks, and the 51.4 payout ratio last year should allow for robust dividend growth in the years ahead. Broadcom is set to benefit a major player in the semiconductor industry, which will become even more important to the global economy. It is estimated that the worldwide semiconductor market will grow at an annual rate of 8.6% from $452.2 billion last year to $803.2 billion by 2028. Because Broadcom is among the leaders of an industry with a promising future, analysts expect the company's earnings will increase 15% a year through the next 5 years. Even though Broadcom is one of the fastest growing dividend payers, income investors can purchase shares at a P/E ratio of less than 18. Price appears more sensible for the stock's healthy fundamentals. So that is it for the four of the safest dividend stocks to help you crush inflation. And you can put yay or nay, I agree and disagree with some, and so I'm more positive and negative against some of them. But I mean, I see the potential behind Hershey. I would say slightly positive. American Tower, I'm totally positive on that one. Union Pacific, totally positive. And Broadcom, where it's a semiconductor. So if I were to list these, I'd probably do number 2 as number 1, Broadcom as number 2, Union Pacific, and I would do Hershey last. That's how I would invest into them. But again, I don't give tax, legal, or trading advice, just stating my opinion. And if you haven't smashed that like button yet, go ahead and hit that for me, as well as subscribing and hit the bells when you're notified of, so you're notified of when the next videos drop. Again, this is J Money, Falling Forward Financial. Happy trading, happy investing, stay green. Cheers.